Plug Power closed the trading session today, October 16th, at $3.68 a share, a notable decline of $0.17, representing a 4.44% drop for the day. While many retail investors watching this dip are likely attributing it to general market jitters or simply a bad day for the green energy sector, the story buried in today's price action is far more specific and concerning. The violent intraday reversal we witnessed, from a morning high of $4.25 all the way down to a low of $3.66, wasn't random volatility. It was a clear signal that the market is beginning to price in a risk that has been lurking beneath the surface for months: the tightening grip of capital markets on companies that promise future growth but consume present-day cash at an alarming rate. The prevailing expectation for a stock like Plug Power has always been straightforward, that it is a primary beneficiary of the global shift to decarbonization. Investors buy into the narrative of a future dominated by green hydrogen, where Plug's fuel cells and hydrogen production facilities form the backbone of a new energy infrastructure. They see the deals with giants like Amazon and Walmart and envision a world where this technology is ubiquitous, making current financial losses a temporary cost of achieving massive scale. This optimistic outlook, however, is now facing a severe test from a much harsher reality. The reality is that Plug Power's ambitious expansion plans, building out a coast-to-coast green hydrogen network, are incredibly capital-intensive. This wasn't a problem when interest rates were near zero and capital was easy to come by. But in today's environment, the cost of that capital is high, and the patience of investors is wearing thin. The 4.44% slide today is less about questioning the potential of hydrogen and more a direct reflection of the market's growing anxiety about Plug's ability to fund its operations and expansion without destroying shareholder value through debt or dilution. The trading day itself told a compelling story. The stock opened at $3.87, slightly above the previous day's close at $3.85, and quickly surged to a high of $4.25 in the first hour of trading. This initial burst of optimism suggests that some buyers saw the stock as a bargain and were attempting to push it higher, perhaps on sector-wide momentum or a specific piece of news. But that rally was short-lived and decisively rejected. From that peak, the stock entered a sustained downtrend for the remainder of the session, methodically breaking through psychological support levels and closing just a hair above its session low. This pattern, a sharp morning spike followed by a relentless high-volume sell-off, is often indicative of institutional distribution. It suggests larger funds may be using the morning liquidity provided by retail buyers to offload their positions. The pressure on Plug isn't happening in a vacuum. It's being compounded by macroeconomic forces. The persistent talk of higher-for-longer interest rates from central banks disproportionately punishes companies like Plug Power. Their entire valuation is based on a discounted cash flow model that projects earnings far into the future. When the discount rate, which is directly tied to interest rates, goes up, the present value of those future earnings plummets. So every time a strong economic report comes out that suggests the Federal Reserve will keep rates elevated, a stock like Plug Power feels the pain directly. It's a mathematical certainty. This is the stark reality that challenges the simple green future expectation. The path to that future is paved with financial hurdles that are getting higher by the day. We are seeing a clear rotation in the market, with capital flowing out of speculative, non-profitable growth stories and into companies with solid balance sheets and current tangible earnings. Plug, with its history of negative PE ratios and significant cash burn, finds itself on the wrong side of that rotation. To understand the company's predicament, one must look at its core business. Plug Power operates in several key areas. Its foundational business has been in designing and manufacturing hydrogen fuel cell systems for the material handling industry. Think of the fleets of forklifts operating in massive distribution centers for companies like Amazon, Walmart, and Home Depot. Plug's GenDrive fuel cells offer a compelling value proposition over traditional lead-acid batteries. They allow for faster refueling, consistent power delivery, and longer runtimes, which increases productivity. This has been their beachhead market, and they have achieved significant penetration here. However, the company's grander vision extends far beyond forklifts. They are aggressively moving to become a vertically integrated green hydrogen company. This means not only supplying the fuel cells, but also producing and distributing the green hydrogen that powers them. They're in the process of building several large-scale hydrogen production plants, most notably in Georgia and New York, with the goal of producing tons of liquid green hydrogen daily. The expectation is that by controlling the entire ecosystem, from production to consumption, they can capture more value and drive down costs. The reality of this strategy is its staggering cost. Building these state-of-the-art facilities requires billions in capital expenditures. This is why the company's cash flow statements are so critical. For years, investors have been willing to overlook the significant negative free cash flow, believing it to be a necessary investment in future dominance. But today's market is less forgiving. Investors are now scrutinizing every dollar spent and asking when, if ever, these massive investments will translate into sustainable profitability. Past quarterly reports have consistently shown strong top-line revenue growth, which feeds the bullish narrative. But digging deeper, one finds that margins have often been under pressure and net losses have remained substantial. This is the fundamental tension at the heart of the stock. Impressive revenue growth clashing with a difficult path to profitability. The market is beginning to signal that revenue growth alone is no longer enough. The demand now is for a clear and credible roadmap to positive cash flow and net income, a roadmap that becomes more difficult to navigate in a restrictive monetary environment. I want to hear from those of you watching. Given their aggressive expansion and the current economic climate, what do you believe is the biggest single risk facing Plug Power over the next quarter? Comment your thoughts below. Looking ahead, specifically at the next 10 days, the stock is positioned at a critical juncture. After today's close at $3.68, it is sitting precariously on a key technical support level defined by the day's low of $3.66. What happens from here will likely be determined by a combination of broader market sentiment and any company-specific news flow. In a bearish scenario over the next 10 days, a failure to hold this immediate support level could open the door to a more significant downside move. If the stock breaks below $3.65 with any conviction, the next logical area of support might be found around the $3.40 to $3.50 range. A more severe market downturn could even push the stock to reevaluate levels seen weeks or months ago. The primary driver of this bearish outcome would be continued strength in economic data that forces bond yields higher, further pressuring growth stock valuations. Any negative news, such as a reported delay in the commissioning of one of their new hydrogen plants or an analyst downgrade citing margin concerns, could act as a powerful catalyst for this downward trajectory. Conversely, a bullish scenario over the next 10 days is also plausible, though it may require a specific catalyst. For the stock to reverse its recent downtrend and make a run back towards the $4 mark and beyond, it would need a reason. This could come in the form of a positive pre-announcement regarding production targets at their Georgia facility, the signing of a new major customer, or favorable news regarding government subsidies or grants tied to the Inflation Reduction Act. A surprise announcement of a significant partnership, perhaps in the stationary power or heavy-duty vehicle market, would certainly reignite bullish sentiment. From a technical standpoint, the first step for a recovery would be to reclaim and hold the ground above the previous close of $3.85. If it can establish a base there, it could build momentum to challenge the $4 psychological level. A cooling of inflation data or a more dovish tone from monetary policymakers would provide a strong tailwind for this scenario, lifting the entire growth sector and giving Plug the breathing room it needs to rally. The company's future trajectory hinges on its ability to execute its ambitious build-out while navigating a much more demanding financial landscape. In summary, the story of Plug Power today is a perfect illustration of expectation versus reality. The widespread expectation is that of a pioneering company leading a clean energy transformation, a long-term holding that will eventually reward patient investors. The current reality, reflected in today's sharp sell-off, is that of a cash-intensive business facing the headwinds of high interest rates and a market that has lost its appetite for speculative growth. The decline from an intraday high of $4.25 to a close of $3.68 was not just noise. It was the market recalibrating its assessment of the company's risk profile in real time. The question for anyone considering this stock is no longer just about the promise of hydrogen technology. It's about the harsh economics of the present. Can Plug Power bridge the gap between its visionary future and its financially challenging present before the well of investor patience dries up? The next 10 days could provide a critical clue to that answer.